Yes, ladies and gentlemen, good morning and welcome. My name is Samuel Campbell, and I will be your moderator for this morning's briefing. We are pleased to have you join us for this virtual Financial and Corporate Service Providers Act industry update, hosted by the Securities Commission of the Bahamas in its capacity as a regulator of financial and corporate services. This briefing is intended to highlight information pertinent to the operations of financial and corporate service providers, and in particular, the Money Lenders Rules 2022, which are currently out for a final round of consultation, which ends on March 15th. It is our hope that through this morning's dialogue, the Commission and the industry at large will achieve a more efficient and effective FCSP regulatory framework. We are delighted to have the Minister of Economic Affairs, Senator the Honorable Michael Alcides, with us this morning to officially open the briefing. And so without further ado, we welcome Minister Alcides as he brings his remarks.
Ms. Christina Roll, Executive Director of the Securities Commission of the Bahamas. Ladies and gentlemen, good morning. It is my pleasure to officially open this industry briefing for licensees under the Financial and Corporate Services Providers Act 2020 and other stakeholders. I have brought remarks at many of these briefings over the years, but this is the first time that I am not doing so on behalf of the Inspector of Financial and Corporate Services. Rather, this briefing is hosted by the Securities Commission of the Bahamas in its own statutory capacity due to the promulgation of the overhauled legislation in 2020. Non-bank financial services and corporate services constitute a vital element of the Bahamas' financial services industry. They are increasingly important for a number of reasons, including the role that the space plays in providing entrepreneurial opportunities for Bahamas-based businesses owned by Bahamians to participate in the financial services and fintech industries. The need for greater financial inclusion, including access to non-bank financial services in the Bahamas. The corresponding need for enhanced investor and consumer protection mechanisms, and the need for well-regulated, internationally compliant corporate services providers and non-bank financial services providers to service the Bahamas wealth management industry. The Securities Commission of the Bahamas advises that as at the 31st of January 2022, there were 248 licensees under the Financial and Corporate Services Providers Act 2020. Those who are not intimately involved in this space may not appreciate the connections with the broader financial services sector and the business opportunities it provides for Bahamian entrepreneurs. There are the more traditional corporate service offers that relate specifically to Bahamian business structures and arrangements such as international business companies, exempted limited partnerships, executive entities, foundations, investment condominiums, and segregated accounts companies. The FCSPA also provides for the licensing of compliance officers and money laundering reporting officers as outsourced compliance services. This creates entrepreneurial opportunities which many qualified Bahamians have taken advantage of to leverage decades of hard-earned industry experience to provide this important service as a business offering. The compliance officer and money laundering reporting officer functions are requisite activities for financial institutions operating either in local or international markets, allowing local talent to effectively export their expertise to international operators in the Bahamas financial services space. For non-bank financial services, the FCSPA framework facilitates significant local entrepreneurial opportunities as well. Examples include money lending, debt collection, payday and cash advance services, financial leasing, financial advisory or consultancy, trading in commodities, other financial instruments, and the newly added custody of digital assets and provision of digital wallet services. Digital assets custody and provision of digital wallet services are a direct result of the passage of the Digital Asset and Registered Exchanges Act, or DARE, at the end of 2020. In addition, the Commission has already approved several applications under the FCSPA for businesses to be licensed to conduct these fintech-oriented financial services. Increasing the public's access to non-bank financial services goes hand in hand with the need for enhanced investor and consumer protection mechanisms. In fact, protecting consumers from abuse is fundamental to why regulations exist and to maintaining confidence in financial markets. The new FCSPA manifests the Commission's commitment to improve consumer protection in a number of ways, but I must highlight and commend the Commission for the bold step it took to ensure the Bahamas was one of the first jurisdictions in the hemisphere to expressly criminalize fraudulent financial schemes such as pyramid schemes, Ponzi schemes, and advance fee schemes. Regional regulators are now looking to the Bahamas' example as a blueprint for how to address these issues in their respective jurisdictions. I expect these provisions will go a long way to empower the Commission to go after the fraudsters and scammers who take advantage of our citizens with these schemes. Similar to the way strong consumer and investor protection mechanisms improve the environment in which legitimate businesses operate by discouraging those who would abuse consumers, world-class regulation is critical for legitimate businesses that want to operate in the Bahamas. Compliance with regulatory best practices and standards is good for everyone. The jurisdiction understands too well the economic and reputational damage done by mere allegations of not being fully engaged in the international fight against money laundering and the financing of terrorism. I'm pleased to say that specifically with regard to AML-CFT measures, the narrative about the Bahamas is increasingly reflecting our long-standing commitment to a clean jurisdiction. This is evidenced in the Financial Action Task Force's December 2021 follow-up and technical compliance re-rating report, wherein the Bahamas was deemed to be compliant or largely compliant with 38 of the 40 FATF recommendations. Finally, I want to leave this audience with a charge to leverage our size advantage to improve this space. When I say our size advantage, of course, I'm speaking about the access we share to and with each other, particularly the access you all have to legislators and policymakers as we aim to balance international regulatory compliance with industry development needs and business development needs with consumer, public interest, and investor protection needs. Here, policymakers, regulators, industry, consumers, and the public can express needs and determine solutions without excessive delays, which provide an opportunity to generate tangible competitive advantage for all stakeholders. This level of access can and should enable the Bahamas to react quickly to the ever-changing regulatory landscape and to stay on the cutting edge of industry developments and innovation. Let us continue and deepen our engagement with each other. The money lenders' rules, out for their final round of public consultation, is a prime example of an opportunity to engage in a formal way and to give input with respect to the direction of the industry. This industry briefing, though less formal, is another way to engage. Without further ado, I thank the Commission once again for the invitation, and I wish you an informative, engaging, and educational session this morning.
Thank you, Minister Alcides. Before we move into our presentation, I would like to advise that this morning's briefing will conclude with a question and answer session. We invite you to submit any questions you have during the presentation using the Zoom Q&A function, and we will address them at the end. Coming now is our Executive Director, Ms. Christina Roll, who will bring a general overview and some developments with respect to the FCSPA, and Ms. Roll will be followed by Leslie Pearson, Gwen Ward, and Michelle Martin-Morrow, who will speak to examination updates, financial schemes, and the Money Lenders Rules 2022, respectively. Ms. Roll?
Thank you, Sam. I want to thank also the Minister for bringing remarks this morning, and to all of you who are tuned in. I understand that we have somewhat over 300 people who may be on the Zoom call today. This is certainly unprecedented for an FCSP industry briefing and perhaps any briefing that the Commission has ever put on. I want also to acknowledge my colleagues who are on the stage and all of my colleagues who have been involved in the development of the financial and corporate services legislation. This morning, I will speak with you, I'll speak to you about, I'll give you just a broad overview of the legislative regime, where we are currently, how we got here. I'll also talk a little bit about the transition, then get a little bit into the money lenders rules. I won't get into the money lenders rules in a lot of detail, just some overarching principles and policies. Michelle Martinborough will later talk about that in more depth. So without further ado, the minister mentioned that as the 31st of January, we had 248 licensees under the FCSP. Now this is down from 347 that we had prior to the transition in 2021. Of those 248 licensees, 192 are pure corporate service providers, 27 are pure financial service providers, and 29 provide both corporate and financial services. I think it's interesting to note within the corporate services space that the Commission has been liaising and trying to create synergies with the registry, the company's registry. And some of the things that we have been doing is reconciling the number of licensees against the number of IBCs that are administered by those licensees. What we've found so far is that of the 24,407, I believe it is, IBCs that the registry has indicated as active, 21,881 of those are attached to licensed FCSPs. A little over 2,000, well, 2,500, a little over 2,500, 2,526 are attached to unlicensed agents. And when I say unlicensed agents, these are people who have never been registered either with the Securities Commission or the Central Bank of the Bahamas. And they've certainly not engaged in the transition process under the FCSP. What this now means is that there are perhaps implications for these unlicensed agents as well as the IBCs they administer. Because if the IBCs are active and the agents are unlicensed, then those IBCs eventually will be in danger of becoming defunct as a result of having an unlicensed agent. So some of the features of the Financial and Corporate Services Act 2020, as the minister mentioned, we removed this concept of the inspector. Now, for some of you, and I think for the layman, that issue is really not a relevant issue for you. But for us in the regulatory world, what this now means is that the Securities Commission, we're not administering this act on behalf of. What it means is that we're administering the act within our own rights and powers. And so that enables us to have a more robust legislative framework. It enables us to have more authority within the Commission itself, and you will see that the legislative framework reflects that. It reflects enhanced investigation, enhanced enforcement powers. We've also, in the new Financial and Corporate Service Providers Act, clearly defined distinct categories of licensable financial and corporate services activities. And I think prior to the enactment of the FCSP 2020, the Commission adopted, I think it was a World Bank list of financial and corporate services that was very loose, and actually the adoption of that list was somewhat sketchy to begin with, and so we had to, but it was the framework of the legislation, and we had to work within it as best we could. The clearly defined categories now, though, allow us to orient the supervision and regulation of our licensees according to their activity. This, of course, is a risk-based approach, not just from an AML-CFT point of view, but it's a risk-based approach according to the activity of the licensee themselves and the conduct framework that we can place on the licensees. The FCSP also sets out a framework for us to apply appropriate capital financial reporting obligations, and these will be defined as you see the activity-based rules come out over the course of the next year and a half. The minister also mentioned that a key feature of the FCSP 2020 is that it criminalizes fraudulent activities. And this is groundbreaking for the Bahamas and perhaps even for the regulatory space in general. We're one of the first jurisdictions to do this. We've specifically criminalized Ponzi pyramid schemes, advanced fee schemes, and we've not done it by calling them what they're known as in the public, but we did it by describing what we mean when we say an activity falls within the parameters of a fraudulent scheme. And that is very important because it allows the Commission as a regulator to assess something that is going on in the market and to determine whether it's criminal or not. Finally, just to highlight, and of course you'll get more on this later, but the Financial and Corporate Service Providers rules are currently out for consultation. I believe we put the rules out on the 2nd of February, and I think Sam mentioned that that consultation period will close on the 15th of March. So as we go throughout this morning, I want you to pay attention very carefully to all of the issues that may arise with respect to the Financial and Corporate Services money lenders rules, because once that consultation period ends, the Commission's intention is to turn around very quickly to address the issues that come out of the consultation, and then to send those rules to the Minister for his no objection. So the current legislative framework consists of an act, and the act provides the broad framework, and so that is the Financial and Corporate Service Providers Act. And then we have regulations, and the regulations get into more specifics with respect to the requirements of the Commission. We've also issued a number of rules to date, specifically the Financial and Corporate Service Providers Fees rules, the Financial and Corporate Service Providers Anti-Money Laundering and Countering the Financing of Terrorism rules, along with some amendments. And we have a number of activity-based rules in the pipeline, and I will get to those later. You should also be aware that there are some AML-specific legislative and regulatory frameworks that apply to the FCSPs, and those are the Financial Transactions Reporting Act, the Financial Transactions Reporting Regulations, the Anti-Terrorism Act, the Proceeds of Crime Act, as well as the Financial Intelligence Transaction Reporting Regulations. Also, the Commission, I believe it was in 2019, put out a policy on the assessment of AML CFT infractions. Now, though that assessment policy is within the framework of the Financial Transactions Reporting Act, but licensees should be aware that that policy applies to the FCSP as well. So when we talk about corporate services in the Financial and Corporate Service Providers Act, what we're really talking about people who are involved in the formation, registration, and management, registered office, registered agent, business either for IBCs or executive limited partners, also people who are providing these services for Bahamian incorporated entities. Additionally, if you want to act as an agent for an executive entity, for a foundation, for a trustee of a purpose trust, as a registered representative of a private trust company, as the governing administrator of an ICON, as a representative of a segregated accounts company, you also need to be registered as a corporate service provider under the FCSP. We also have a provision for outsourced compliance services. And so this is very interesting because what it clearly shows is that the Commission has recognized that outsourced compliance services has become an important function within financial services. And it is clear that it is our intention to address this as a category within itself. And so we have outsourced compliance services also as a part of corporate services. And when we speak of financial services under the FCSP, we're talking about money lending, money broking, payday and cash advance, credit extension. So these are 4 categories really that can all be described as money lending for the purposes of the money lending rules, with the exception of money broking. But certainly money lending, payday and cash advances, credit extension, you should all pay attention if you're within these categories because the money lending rules will have implication for you. Also, bill paying services, debt collection, financial advisory or consultancy, financial intermediation services, trading in commodities and other financial instruments, custody of digital wallets, and wallet service providers are all considered financial services under the Act. Another thing, one thing that financial service providers would perhaps note that is different in the FCSP 2020 than the FCSP 2000 is that for the most part to provide financial services you have to be a corporate entity. The Commission is not accepting individuals to provide financial services, and the reason for that is simple. It's that we intend, as the rules roll out, to require financial reporting requirements for financial services entities. And there will be a range of financial reporting obligations, and it could be as far as providing audited accounts in the case of money lending. So we thought that it was important that the framework had to include a corporate structure for the provision of financial services. So as far as the transition since the enactment of the legislation in 2020, the transition was for 6 months. So the period officially ended on the 14th of June, 2021. The Commission, however, does have the power to extend that transition period. We have not formally extended the period, but we do believe that there may be some need to extend the period, particularly as there may be entities that are unlicensed and unaware that they are now required to be licensed. So our intention is to engage in briefings such as this to educate the public on their need to be licensed and also to address those unlicensed entities as quickly as we can. So during the transition, we mapped and I don't like to use the word grandfather, but I think we understand what we mean when we say grandfathered. We mapped and grandfathered all of our licensees that applied under the transition process to the FCSP 2020. Now the transition process was very simple. We sent out a notification to all 347 of the licensees that were registered with the Commission pre-transition. We gave you all a checklist to indicate which services you are providing, and we ask you to return that checklist to the commission. After that, we set about the process of grandfathering in all of those licensees that participated in the process. I think you also had to be up to date on the payment of your license fees, of course, and some other compliance obligations with the commission. Of the 347 licensees that we had at the end of 2020, we have about 248 licensees that are currently existing. Now that means that some 100 licensees didn't transition. What that means that they are no longer licensed to provide either financial or corporate services. So we received from the licensees all of the old certificates, and everyone now should have been issued with a new certificate under the new FCSP. We also engaged in an exercise with former, well, they're not former, they're still current licensees of the central bank who were formerly exempt from the old FCSP. We engaged with a process of grandfathering them into the new legislative regime, and that exercise is more or less complete as well. We still have some outstanding matters to address licensees in Grand Bahama and Abaco. I think we only have one licensee in Abaco, but we have a handful in Grand Bahama, and we intend over the coming weeks, it says here on my slide months, but it's really over the coming weeks, to address these physically in Grand Bahama. So we intend to send someone to Grand Bahama to address some of the outstanding matters. I mentioned earlier that we also have been strengthening our relationship with the company's registry. And so the registry and the commission is now on the same page with respect to any persons who are seeking registration as agents must first be licensed with the commission. And those those agents who fail to regularize their registration, they'll likely be subject to penalties and or sanctions. I mean, so the ultimate sanction with respect to failing to not failing to, but operating without a license is a criminal sanction. But as I said, we will be working with the registry and those agents who are still unlicensed so that they can regularize their position. I want to circle back, if I could, just to address central bank licensees who were formerly exempt under the old FCSP. And I know that there has been quite a bit of angst in the marketplace with respect to whether those central bank licensees still now need to be licensed both under the FCSP and still require a nominee trust license by the central bank. So I don't think I would be speaking out of turn, but I think I can say that the Commission and the central bank has developed a joint statement that we plan to issue fairly soon that sets out what the position is from both of our perspective, and also it clarifies whether central bank licensees also need to be licensed by the central bank. So for those of you who are not aware of this issue, just to give you a brief overview, some of the things that we have discovered, and we discovered these issues going through either the OECD's international review process for legal persons and arrangements, as well as our most recent FATF review in 2015. We realized that there were regulatory gaps between how corporate services were being regulated under the FCSP versus those corporate services that were being regulated that were exempt from the FCSP. In order for the jurisdiction to be compliant with international best practice, it was important for us to align the regulatory framework for corporate services to ensure that they are compliant with international best practices, as well as to eliminate those gaps. We also needed a single regulatory framework for corporate services to avoid the issue of regulatory arbitrage. The FCSP, by removing the previous exemption, has achieved that. So whether someone is a licensee of the central bank or not, they are still compliant with the same corporate services rules that anyone who's providing corporate services in the Bahamas must comply with. Now, what that means on a practical basis for central bank licensees is that they must also be registered with the Commission under the FCSP. As I mentioned earlier, we grandfathered in existing licensees to make the process as smooth as possible. And I think it was fairly smooth. But it also means now that a nominee trust license, which was issued by the central bank, is no longer required for persons providing registered agent, registered office, or other corporate services. It means that a central bank licensee can now provide corporate services with their FCSP license only. A feature of the FCSP that would be applicable in this space also, and it should be noted, is that a subsidiary of a licensed FCSP providing corporate services, including nominee services, solely for its parent. So what that means is if XYZ is a corporate service, XYZ Company Limited is a corporate service provider, and they have XYZ Nominee Directors Limited as a subsidiary. What that means is that XYZ Nominee Directors Limited can provide nominee director services on behalf of its parent without requiring a separate license. But it also means that licensees of the central bank, they must submit to the supervision of the Commission with respect to the provision of corporate services. Now that said, and I just want to stick in there and just caveat that by saying that the central bank and the Securities Commission, we're currently engaged in developing an MOU with respect to the supervision of these licensees. We don't really want to duplicate any efforts, and we know that the central bank looks at a corporate structure when it is within the framework of a trust. So for a licensee that is purely has corporate structures within the framework of a trust, what you will practically see is that you'll likely only be examined by the central bank. Now, if you also have standalone corporate services, then those standalone corporate services, you'll probably, from a practical point of view, also be examined by the Securities Commission. I'm winding down quickly, but I just want to also highlight to you all of the financial services rules and the priority with which the Commission intends to develop them. At the moment, we have out for public consultation the money lenders rules. Next, you will see coming out the financial and corporate service providers rules. And this is probably going to be the behemoth of them all because we have a lot of corporate services to cover and we have a lot of issues to address with respect to the conduct of corporate service providers. Next, you'll likely see debt collectors rules, credit extension rules, trading in commodities and other financial instruments rules, the custody of digital wallets, wallet service rules, intermediary rules, bill paying rules. And finally, we have an asterisk with respect to financial advisory and consultancy services rules, because the Commission is currently reviewing this category of licensee and trying to rationalize whether, based on what we see as activity in the space, whether the need for these rules, and this specific activity is really warranted. And so, as I set the stage for what will be Michelle's in-depth talk later, I just want to talk briefly about the money lenders rules and what really are the drivers behind it. And so for those of you who have not been privy to the development of these rules over the past 5 years, you will know, you may want to note that the genesis of these rules really started as a part of the compendium of some consumer protection legislation, and I think it was the legislation was around the Homeowners Protection Act. But really, the main driver here is consumer protection. Let's make no mistake about it. We find that non-bank lending in the Bahamas is steadily increasing. I mean, and I say steadily increasing, but that's really a conservative estimate. It's growing rapidly. And with that growth, there is a very strong need to protect consumers against predatory practices by creating standards and rules for the conduct of non-bank lenders. Currently, no standards or rules exist, and I wouldn't say that the territory is exactly the Wild West, because I find that, and I think the Commission finds that most lenders in this space, they have experience as bankers, they have experience in other consumer lending practices, and they are applying best practices as well as they could. However, there are always bad actors, and those bad actors, if left unchecked, they will do as much as they think that they can get away with. And so there is a need to protect the consumer against this. While at the moment I can't say we have any specific statistics with respect to predatory practices, and that is simple. We just didn't have any mechanism to gather those statistics in the past. But we certainly have a lot of anecdotes. We've received a number of complaints, allegations of harassment, and you will find that a lot of the issues that the Commission is seeking to address are coming out of some of the issues that are known to us that are existing and that are harmful to consumers. Now, I've heard a little bit of chatter, so I just want to address, or try to address, as I said, Michelle will go into it a little bit later, mostly from a legally technical point of view, but I want to go into it from perhaps a more practical point of view, and that is to address who exactly is a money lender. And so for our purposes and the purposes of the administration of the Act, a money lender is a person who, whether as a principal or an agent, carries on the business of money lending. Now, that word business is very important because, you know, we lend money. I lend money out. I lend out some money yesterday. But I'm not in the business of money lending by virtue of lending money to my niece or my nephew. I'm in the business of money lending when I have created a framework, a structure for lending money to third parties such that I want to gain a profit from this business, okay? So a person is presumed to be a money lender if they're lending money or purchasing loans in consideration of a larger sum being repaid by the borrower, or if they're advertising or announcing in any way that the person is a money lender. They carry on the business of money lender, where in the regular course of their business or commercial activity, they lend money or purchase loans for the purpose of making a profit. Now, that issue of the purpose of making a profit does not necessarily include a small rate of interest you might charge a family member or a friend. It means that you are consistently doing this activity in order to make these types of profits. So who is not a money lender? So the rules do not apply to any person who is licensed by the central bank under the Banks and Trust Companies Regulation Act. Those persons are banks, and while they lend money, they do so under their banking license. For our purposes, a money lender is a non-bank lender. Also not included is an insurance company that is licensed under the Insurance Act. So an insurance company can very well lend out money to its customers, and they're not included under this act. For the purposes of their activity, they're licensed by the Insurance Commission of the Bahamas. A cooperative or credit union registered under the Bahamas Cooperative Credit Unions Act is also not included, and these rules do not apply. Those persons are, again, licensed and regulated by the Central Bank of the Bahamas. So pawnbrokers or secondhand dealers licensed under the Pawnbrokers and Secondhand Dealers Act are covered by the Compliance Commission and also do not fall into this category for the purpose of defining a money lender. And perhaps most important of all, and to address some of the chatter that I've heard since the rules went out for consultation, loans from your family, your friends, or related parties that are extended because of your existing relationship with them and not because you are in the business of money lending also don't fall within these rules. And notwithstanding any of that, any interest-free or no-fee loans or advances do not fall within the framework of these rules. Now, with that said, the Commission is aware that there are a number of persons who may be individuals, who may be investment companies, who may be corporate entities, who are in the business of money lending and who are not licensed by the Commission. We would encourage you to regularize your position because the rules will have implication for your ability to enforce if you remain in an unlicensed state. It will, however, you will be required, however, to structure yourself as a legal entity. Money lenders, I should also point out, and I think I mentioned it earlier, will also be eventually required to provide financial reporting to the Commission. And finally, as I wrap up and about to hand over to Leslie, I just want to say that for any person in this space who may find themselves in a position where they are unlicensed, the Commission, under these rules, from the date of the commencement of the rules, you'll have 90 days from that date to apply to the Commission to regularize your position as a money lender. Certainly, though, we will see if any further extension is needed, depending on the activity that we see coming in and the time it'll likely take to regularize it. So with that, I would like to say thank you for listening. I will be here at the end of all of the presentations for questions and answers. I now turn over to Leslie.
Thank you, Ms. Roll, and good morning once again. The Risk Analytics and Examinations Department is responsible for risk-based analytical reporting and risk rating, review of statistical data, and conducting examinations of entities licensed as financial and corporate service providers administered by the Commission. Priorities establish, identify key areas of risk, existing and emerging, within the sector, which licensees may focus on to evaluate and improve their compliance programs. Obviously, the legislative updates are to the left of the screen, and some of those Ms. Roll talked about earlier, and we'll continue to have discussions on those. Some of the updates that are important in terms of, from an examination standpoint, are making sure going forward that the organization has an approved compliance officer and an approved MLRO, and I mean approved by the Commission, and also implementing a risk management framework and a risk-based approach to monitoring facilities. Under the new 2020 Act, the Commission, you are required to appoint a compliance officer with our approval. The compliance officer and the MLRO may be outsourced in whole or in part. However, we must be provided with a copy of the executed outsourcing contract, and the contract must, at a minimum, contain the following. It has to stipulate what the outsourcing services to be provided are, the responsibility of the outsourced compliance officer and the licensee, the terms of service regarding the inspection of the records by the licensee or by any person authorized by the licensee, the terms of service including remuneration, conditions of amendment, termination, indemnification, and any other considerations, access by the Commission to documents of the licensee, including the working papers and notes of the compliance officer, the protection of clients' confidentiality in accordance with the laws of the Bahamas, and the prohibition of subcontracting, delegating, or appointing of any other person of the outsourced compliance functions by the compliance officer. Notwithstanding any outsourcing of that function, the responsibility always obviously remains with the licensee, who shall continue to monitor the performance of all the compliance functions to ensure proper and effective performance thereof. There's also indemnity insurance that now has to coverage, and this shall be in an amount obviously appropriate to the activities, the scales, and the complexity of your business operations. So as an example, for some financial service providers who are perhaps money lenders or maybe in the future wallet service providers, obviously your coverage would have to be sufficient to cover the insurable risk of your business. Under the 2020 regulations, there's also a duty to implement data protection measures. These need to be consistent with the Data Protection, Privacy of Personal Information Act. Financial and corporate service providers, licensees must have protocols in place for the collection and storage of personal data. There must also be appropriate security measures in place to prevent unauthorized access to or alteration, disclosure, or destruction of personal data. And finally, there must be rectification or erasure of any data which is inaccurate upon the written request of an affected person. Okay, so for self-risk assessments, a directive to submit self-risk assessments to the Securities Commission was issued last year with an initial due date of October 22nd, 2021, and a final extended date of December 31st. To date, in respect to financial and corporate service providers, we have a 85% compliance rate, and there are about 15% of licensees that remain outstanding. As a result, penalties were issued earlier this year, and know that maybe possibly further enforcement action can happen for those who have not complied. Per Section 5 of the Financial Transaction Reporting Act, 2018, every FI shall document in writing the outcome of a risk assessment and keep it up to date and make it available to the relevant regulatory bodies upon request. Your risk assessment should be based on your your facility holders, their countries, their jurisdictions of origins. It should look at your products, your services, your delivery channels. Risk assessments also have to be done prior to the launch of a new product, any new business practice, or prior to the use of any new or developing technology, or when there's a major event or development in the management or operation of your group. There is no prescribed format for this risk assessment, but the information covered in Section 5 of the FTRA has to be included. To assist licensees in this effort, the Commission developed a template, and you could feel free to reach out to your risk officer should you require a copy of this template. I know anyone who hadn't submitted initially by the October deadline, the templates were sent out to assist you in completing by the December deadline. So just looking at our last 2 years in review, obviously during the first quarter of 2020 and the beginning of 2021, exams were postponed due to COVID-19. So we did have one FCSPA exam completed at the beginning of 2020, and there were 15 in 2021, which resulted in some deficiency letters being prepared and a total of 61 breaches identified, split almost evenly between business conduct and AML-CFT. So 49% of the breaches that stemmed from business conduct, and that accounted for licensees' inability to be compliant with continuing obligations and registration with the Commission regarding material changes, in addition to not being compliant with several legislative requirements. So Section 18 of the Act imposes a duty to notify the Commission of changes relating to registration, which shall be immediate for any of the following changes, and that's such as your address, if your contact information change, your email, your phone number, postal addresses, if the principal place of business changed, if your insurance coverage changed, if your attorneys changed, if your corporate office changed, your registered office or registered agent changed. Some other areas we had were the annual declaration update form that's to be completed annually by January 31st. And so please make sure they're in on time. Then we had some issues there was also with the management of accounting records. And so it's important and note that it should be on file for each of your IBC clients. If as a licensee you're unable to get the declaration, you should consider resigning your services. Section 19 of the Act also imposes a duty to obtain approval for certain changes. And these changes are as follows: if you're merging with another licensee or entity, if you're issuing, transferring, or otherwise disposing of any shares in a company or any partnership licensed under this Act, or if you're appointing any director to a company licensed under this Act, or if you're adding to or reducing the shareholders of the company, or if you're making any changes to your auditors. Those changes should be brought to the attention of the Commission, and you should have prior approval. So next we're going to look at the other 51% of the breaches stemmed from anti-money laundering, countering the financing of terrorism, AML-CFT. So as discussed earlier, MLROs and compliance officers must be approved. Further, the MLRO, you must be registered with the FIU. So even though you come to us for approval, it is important that then you go on to the Financial Intelligence Unit and have your MLRO registered with them so that they're properly able to upload any STRs that may come forward or any other relevant information. The risk rating framework is important to the understanding and functioning of the licensee's business, and it should be approved by senior management. The framework should speak to the risk mitigating measures employed by the licensee and requires each of your clients to be risk rated. For the IOMA orders, there are declarations required, and each of these should be completed and submitted to the Commission. It is important to review your client listing and ensure that they're not on any UN sanctions list or any other list that may exist, and that you're not working with bad actors, obviously. Finally, we found that some licensees did not implement clear procedures and controls for verification of PEPs, either when initially onboarding a PEP, and if that person is a director, officer, founder, council member, a partner, or a trustee, or if they're signatory, or if they have beneficial interest of 10% or more in the legal entity, or if they have principal control over the legal person's assets, or if they exercise any control in the management of the operation, or when continuing a business relationship with a client that has become a PEP subsequent to establishing the relationship. So, we want to point out there's absolutely nothing wrong with having PEPs as clients, but just make sure that you have procedures in place to manage this process. There's also a definition that's put in there now, and it refers to an individual who holds or has held within the preceding 12-month period of the proposed business relationship a position in the executive, legislative, administrative, military, or judicial branches of a government, whether elected or not, including the positions of head of state and head of government, senior official in any major political party, or a senior executive in a major statutory or government-owned corporation. And this also includes any parents, siblings, spouses, or child of any of those above individuals. And also any corporations or businesses or entities formed by or for the benefit of a head of state or a head of government. And we've seen there's been a marked increase in difficulty while assessing registrants, obviously, during the pandemic. But many reporting timelines were relaxed during this period. During 2021, however, we did aim to foster return to strict compliance with reporting obligations, and we did resume on-site and off-site review of registrants. And obviously, having compliance is very important, and it should be considered important to you as well when we look at these entities, because of course we want to, it allows us to enable the mandate of the commission to be enforced, which we want to ensure orderly, fair, equitable dealings, fostering timely, accurate, and efficient disclosure of information to the investing public and the capital markets. So in closing, just consider the following as you go about your business. Ensure that there are proper policies in place which govern the daily operations of your organization. Ensure there's a comprehensive business continuity and disaster recovery plan. Obviously, the pandemic further highlighted the importance of this. During this time, we saw, there was a difficulty with some licensees in terms of accommodating virtual exams. But also be sure to ensure your awareness of your continuing obligation requirements. In addition, please try to be more responsive to the risk analytics and examination team. And this eliminates the lag of receiving documents back and forth and ensures timely submission to expedite testing and review and analysis of data. And reach out to your supervision officer periodically to ensure you're aware and kept up to date. Further, please ensure your compliance officers are reviewing legislation, they're keeping up on best practices, and if you want, they can consider joining organizations like BACO, and those things are important to allow the jurisdiction to continue in a good manner. This concludes my segment of the presentation, and now I will hand over to Gwen Ward, who's the Senior Management of Enforcement.
Thank you very much, Leslie, and good morning, everyone, once again. As you are now aware, the Financial and Corporate Service Providers Act came into effect the end of 2020, that's December, and included were provisions to address long-standing issues with fraudulent programs or schemes. Now, these activities were not covered before, namely scams and fraudulent schemes, criminal activities, and they are now referred to under the Act as financial schemes. Fraudulent schemes or scams have been and continue to be a major issue in the Bahamas, as you've heard already, people losing their money, and the inspector had no means of addressing these matters. Now, with the FCSPA having criminalized such schemes, this presentation will now cover what is a financial scheme, the impetus for the decision, who is liable, and what deterrence the Act provides, or the penalties. And so here are some of the schemes, frauds, or scams that we're most familiar with. Over time, the FCSP, the Securities Commission, has received complaints concerning all of the more prevalent or well-known frauds or scams outlined here. You see, for example, Ponzi scheme, the pyramid schemes, the scam posing as a multi-level marketing or MLM scheme, and I say posing because there is no viable product really, the advance fee fraud, and market manipulation. And all these schemes are designed to benefit the scheme's originators and to some degree the promoters, where there are any, of course. Time and again, these schemes masquerade as, or they certainly lay claim to being, legitimate programs. So, their prevalence aside, the considerable number of reports and complaints about fraud schemes to the Commission, which had no recourse for addressing them, was a primary impetus to include the provisions that we will review shortly. So, still looking at the impetus, here are some statistics involving Commission investigations. We reviewed various financial schemes that were investigated between 2010 and 2020, and you will see that there were 26 in total over the period in question, but there were 20 in the year 2020 alone, and that's that blue the mark there on the graph. And so that's of particular interest because solely due to the COVID-19 pandemic, we know that this increase in schemes, while it may be sheer coincidence, I think it is fair to say that the pandemic resulted in a greater part of the Bahamas' population becoming homebound and being online, of course, far more than usual. So it at least also appears to have allowed for greater opportunities for originators of financial schemes or scammers. Also, we did note that the most prevalent scheme over the time reviewed was the pyramid or the MLM scheme. And so, note again that before the FCSPA 2020, the Commission was not empowered to address fraudulent schemes or scams. They're now called financial schemes, and they are unlawful under the FCSPA. I will not read through all of what you are now seeing, that is the definition, but we will look broadly at what is covered in terms of types of schemes, noting that there may be some overlap. And so you will see here A through D that covers pyramid or MLM schemes. And E through G, essentially, what is covered there are advance fee schemes or advance fee fraud. We see here the first one, E, where persons are required to pay an advance fee either as a lump sum or by installments in order to receive a larger financial return, which is solely based on the number of persons recruited to the scheme. Some of you may be familiar with that. And here, H through I, this covers Ponzi schemes. And so part of the marketing or promotion of the scheme involves assertions or statements guaranteeing or promising that participation in the scheme will result in returns which far exceed the returns offered in the investment market. You may recognize that as part of a Ponzi scheme. And lastly, we see J, which covers any other arrangement that may not have been identified up to now. And so it allows the Commission then to address such matters as necessary. You will note that the ASU is actually not included in the definition of financial schemes, and it was intentionally excluded from this law. What I will call the traditional ASU remains outside the purview of this legislation. That is, a circular program involving a defined number of people contributing to each other equally over a set time period. And of course, it relies on that set or defined number of people involved. Each must wait his or her turn to receive a draw or a payment. However, the provision does implicate the so-called public ASU, which, if you break the activity down, is really nothing more than a Ponzi scheme. And this is evident from how it functions or operates with its non-circular or open-ended approach, which is very similar to a Ponzi scheme. And so for clarity, financial schemes as defined are unlawful. Because the activity is illegal, they cannot be licensed. So there really is no redemption for this activity. And so we look at the provisions that cover the Commission's authority to address this. We have sections 30 through 33 that empowers the Commission to investigate and obtain or cause the production of documents or material relevant to a financial scheme. And under section 46.2, which actually creates the offense, any person who A, launches or establishes, promotes, markets, or advertises any financial scheme, or B, invites or recruits any other person to join or participate in any financial scheme, commits an offense, and is liable on summary conviction to a fine not exceeding $100,000. So, from this, you see that any person who joins a financial scheme then invites or encourages others to join may, through those actions, render himself or herself liable to prosecution. So the potential consequences for a person who, whether intentionally or not, invites or recruits any other person to join or participate in any financial scheme is criminal liability. And certainly, where any person promotes, markets, or advertises the financial scheme, he or she can be held liable under the Act. And so remember, when doing your due diligence on an individual or an entity, don't forget to check the Commission's website for whether the person has a FCSP license. And finally, if you have a complaint, it may be made via the Commission's website. Just click on the Investor tab, and then click on Complaints, which is circled there in red, and it will take you to the Complaints page. Now, with that said, ladies and gentlemen, I now hand it over to our Senior Legal Counsel, Ms. Michelle Martinborough, who will now provide an overview of the money lenders' rules. Michelle?
Thank you, Gawain. And good morning, ladies and gentlemen. Gawain took me a little bit by surprise. Just now, he's usually much more long-winded, and so I'm surprised to be up already. Thank you. Today, I am tasked with providing you a summary of the Financial and Corporate Services Money Lenders Rules, which I will refer to as the rules or Money Lenders Rules from here on. My aim in this presentation will be to provide you with a clear understanding of the objective, the scope, and regulatory regime being established by the legislation. The Securities Commission of the Bahamas was tasked some time ago, as Ms. Rowe mentioned, to develop legislation that would address various issues relating to non-bank money lending in the Bahamas. Many of these issues were consumer protection based. However, some also involved establishing a regime that allows this sector to thrive and develop so that it meets the needs of the Bahamian public in a responsible way. With these drivers in mind, the Commission sought to develop money lenders' rules that are robust and in accordance with best practice. The proposed money lenders' rules include various core elements that are introduced to strengthen the operation and oversight of the sector. These core elements include requiring the money lending activity must be conducted only by a legal entity, ensuring that a money lender's funding capital is satisfactory, establishing standards for the conduct of money lending business, providing statutory reporting obligations as well as consumer protection standards. There are also specific requirements around money lending contracts. The rules also address enforceability of lending contracts, the prevention of money laundering and the financing of terrorism and provides offenses for breaches and misconduct. The first issue to address, of course, is the applicability of the rules. And Ms. Roll spoke to this in her presentation to some extent. But this section of my presentation will lay out the legal, technical basis for how it's applied in the rules specifically. So Section 3 in the rules provide very clearly that the rules apply to persons that are carrying on the business of money lending and to contracts for money lending. And here I'd just like to point out that we are covering two elements. We're covering the activity by the money lender as well as the contract itself. So money lender in the rules is defined as any person who as principal or agent carries on the business of money lending or purchases loans, whether or not this is that person's primary business. Breaking it down, a person is considered a money lender and caught under the rules if they are, one, carrying on business, and as Ms. Roll pointed out, that's the important factor. Two, that this business involves lending money to others. Or three, that business involves purchasing loans. It does not matter whether this activity is the primary focus of your business. If you lend money and or purchase loans as an ancillary or add-on service, then you are subject to oversight pursuant to these rules. Therefore, what constitutes carrying on the business of money lending? Rule 2.2a provides that a person carries on the business of money lending where in the regular course of business or commercial activity, a person lends or purchases loans for the principal purpose of making a profit. Furthermore, the rules specifically provide at Rule 2.2b that a person is not considered to be carrying on money lending where a person lends money as a one-off or occasional private transaction. So this is the bit that addresses the chatter that Ms. Roll spoke about. And so it expressly removes lending between family members, friends, colleagues, just the one-off type of private occasion from the remit of the legislation. We, as noted, we were aware that the issue was being talked about, and there was concern whether private transactions were caught. So we specifically provided for the exclusion for them in Rule 2.2b. This approach is congruent with the overall objective of the rules, which is to address the business of money lending and not the general activity of money lending. As a matter of note, the following carve-outs have also been provided so that the rules do not apply. And I think Ms. Roll went through these, but I'll summarize them very generally as well. So the rules won't apply to agreements where no interest is applied, to persons non-resident for exchange control purposes who are lending outside of the Bahamas, to licensed pawnbrokers, or to licensees of the Central Bank and the Insurance Commission. At this point, I note that the legislative framework for financial and corporate service providers begins with the Financial Corporate Services Act. The legislation is structured so that the general overarching principles and requirements are in the Act, and specific details and requirements relevant to particular categories of activity are spelled out and developed at the rule level. Having established that you are in fact carrying on the business of money lending or intending to, and are not within one of the exempt categories, squarely places you in the remit of the FCSPA and these rules. So I want to point out that you are covered by both the Act and the rules, and there may be provisions at both levels for you to consider. So the first step is to check at the level of the Act to determine what general standards and requirements apply to all financial activities under the FCSPA. It is important to note that once you fall under one of the categories identified in the Act, you are a financial and corporate services provider that is conducting the specific activity of money lending. Therefore, you are first required to meet the requirements of the Act and then meet the requirements of the rules, specific to your activity, in this case, money lending. Case in point, the first requirement for money lending is to be licensed to conduct the business. This obligation is found in sections 4, 6, and 7 of the FCSPA, the Act, where the general requirement for all financial and corporate services providers is found. The specific requirements for a money lending license are provided in the money lending rules. This way, the legislation is able to develop frameworks bespoke to the activity and take account of sector-specific matters. In this vein, licensing requirements specific to money lenders include, as Ms. Roll also noted, that a money lender must be a company, an IBC, or a partnership organized under the Partnership Act. An application is required to be submitted to the Commission that informs the Commission of the applicant's details, its intended business, and provides due diligence sufficient for the Commission to make a full assessment of the application. A key element of the application is the required submission of information concerning lending capital and funding of the applicant. Of particular note, the applicant must advise in his application details of how it is funded, the amount and source of funding, as well as provide details surrounding shareholdings. Further details related to operations, policies, procedures, and business plans are also required. I note that the Act also makes FCSP licensees responsible for anti-money laundering policies and procedures. And of course, the applicant must be fit and proper. A money lender at the time of its application must satisfy the Commission of its funding, as I noted earlier. When the provisions of Rules 26 and 27 are read together, it means simply that the Commission must be satisfied of the details and legitimacy of the funding. Currently, there is nothing akin to a regulatory capital requirement. As noted in my previous slide, the rule establishes the base requirement that an applicant must provide details of how it is funded, the amount and source of funding. It is essential to note also, however, that these rules also prescribe what sources of funding or financing or funding are acceptable for a money lender to use. It must also be noted that this provision does not only apply at the point of application, but will also be applicable throughout the life of the money lender. The appropriate list of funding sources includes the money lender's own capital, promissory notes, debentures or bonds, overdrafts, loans, or equity partners. As alluded to throughout Ms. Rowe's presentation, as well as at the introduction of mine, one of the key objectives of this legislation is consumer protection and setting standards for how business should be conducted in the sector. The lack of oversight of money lenders leaves borrowers vulnerable to misconduct by money lenders, and this can have very serious consequences for the development and health of the sector. The code of conduct included in the rules requires that the money lender deal fairly with its clients. Specifically, it requires honest responses to customers' needs and requests, offering customers suitable products and services, corresponding with customers in a clear, transparent, and timely manner, and ensuring that customer representatives are competent and properly trained. The rule establishes a responsible lending standard requiring that the money lender consider the customer's income, taking account of the customer's committed and essential expenses, as well as other factors that could affect the customer's ability to meet the terms of the agreement. This standard also requires that the money lender develop a written responsible lending policy that addresses the details of how the money lender will assess a loan application. For instance, how income and expenditure will be assessed, and what is the acceptable evidence acceptable evidence of the income. The rules also spell out other specific areas that must be addressed in the policy. So on that point, I just want to note that there is this new standard. There is a standard of having a responsible lending policy. That policy must be in writing. The rules also require that the moneylender disclose specific loan product information like payment terms, interest, and the total cost of the loan, and these details are required to be disclosed before the agreement is executed. Finally, the rules permit the use of simple interest only and require that loan agreements do not exceed the rates under the Rate of Interest Act. And that was just a finally for that slide. So we have more slides to go, and I apologize. But as with many other financial services, money lenders are required in the rules to meet various ongoing obligations, including keeping records, which in this case is loan and account records. The rules also require that moneylenders prepare annual financial statements for submission to the Commission. And again, Ms. Roll alluded to that fact, and it is clearly provided in the legislation, and once these rules are enforced, moneylenders will be required to submit audited financial statements. Further, moneylenders must notify the Commission of any material changes, any changes in directors, as well as any addition or reduction of shareholders. Therefore, in summary, the moneylender must notify the Commission of anything that has changed in its operations or the structure of the moneylender, which includes an intent to voluntarily liquidate or to dispose of its loan portfolio. The rules also provide that a money lender has a duty to cooperate with the Commission, provide information, and submit to inspections. When developing the legislation, the Commission was made aware, and Ms. Rhodes spoke to this as well, of certain inappropriate conduct within the sector, which we determined must be addressed directly in the rules. These standards relate directly to consumer protection. The first step was to criminalize threats, intimidation, or assault on borrowers who may be in default. It should be noted here that the rules provide that a money lender can only assign a debt arising from a defaulted loan to a person licensed under the FCSPA to conduct debt collection. So you can't have your best friend go and beat up somebody to get your money back. The rules further establish a framework for when a money lender can deal with or dispose of a borrower's collateral. In this regard, the rules prohibit the money lender disposing of collateral except where the borrower has defaulted, and the money lender has provided 30 days written notice of its intent to enforce the security. A money lender is further required to ensure that its employees are duly qualified, fit, and proper person. This includes an obligation for the money lender to train prospective employees on internal policies, procedures, and controls. If I have not put you in a state of deep sleep by now, you might recall at the beginning of my presentation that I defined the remit of these rules as also including the activity of money lending as well as the contracts for money lending. Through its benchmarking, the Commission noted that best practice of the regulation of money lenders also included provisions that set standards for the content of money lending contracts. This approach ensures that there is a holistic coverage of the sector's activity and that as far as possible there is no ability to contract out of or around the conduct standards. The rules require that the agreement is in writing and that a number of key elements are included. Moreover, the borrower, grantor, or co-signer must sign the agreement. The terms required to be included cover the date, amount, interest rate, details of the debt of the lender and borrower, fees, security, etc. There is then the catch-all that will allow the Commission to determine that a specific type of contract should properly include additional terms. So as well as the ability to as well as the standards that are set within the contract, the Commission could at some point say, look, this type of contract that we're aware of also needs to have an additional type of term in it, and we can prescribe that outside of the rules. The rules not only provide what must be included in the money lending contract, but also specifically addresses circumstances when a money lending contract would not be enforceable. These circumstances largely reflect the general terms required to be in the contract, so that if these standards were not met, the contract would be unenforceable. For example, if the borrower does not sign the contract, or if the terms required to be included in the contract under these rules are not included. There are, however, additional standards introduced in these provisions that invalidate the contract. For instance, if the contract imposes early payment penalties, provides restrictions on duties owed by the lender to the borrower, or includes terms to increase fees or interest rates because of a default in the loan payments, the contract would also be considered unenforceable. Further, an agreement that imposes costs, charges, or expenses that exceed 2.5% of the principal sum borrowed is also unenforceable. It is also very important to note that any money lending contract and any security given by a borrower will be unenforceable where the money lender is not licensed. In developing the rules, it was also apparent that there were distinctions to be made between mortgage lending and regular money lending. So Part 4 of the rules therefore addresses money lenders who provide lending or financing for mortgages. The rules specifically provide that a money lender will be deemed to be in the business of mortgage lending or financing where the loan is made for the purpose of 1, purchasing vacant property for the construction of a dwelling house, 2, the purchase of a dwelling house, 3, the purchase of commercial property whether developed or undeveloped, or 4, purchasing mortgages or loans in default which are secured on a borrower's dwelling house. The rules establish standards applicable to money lenders purchasing mortgages or loans that are in default and attached to a borrower's dwelling house. These standards prohibit a money lender from increasing the rate of interest to being higher than the rate under the former terms of mortgage or loan. It also requires the borrower to pay, if the agreement also requires the borrower to pay any fees associated with the purchase of the defaulted mortgage or loan and is offering the borrower new pay terms that place the borrower in a worse position than had the loan not been purchased. These provisions protect the borrower from being taken advantage of or unjustly treated because of their circumstances. Part 4 also provides where a loan or mortgage with respect to a borrower's dwelling house goes in default due to a non-payment of principal or interest by the borrower, the Homeowners Protection Act will apply. This slide is just a reminder that money lenders, or an advisement that money lenders are also obliged to comply with the provisions of the Financial Transaction Reporting Act and all related legislation applicable to the fight in preventing money laundering and the financing of terrorism. And I'm sure that you are not surprised that the rules stipulate that any breach of the rules by a money lender, its employees, or any person engaged by the money lender is an offense, punishable by a fine, imprisonment, or both. The rules also expressly provide for conviction of directors and officers of the money lender in their personal capacity. Therefore, where an offense has been committed with the consent, connivance, or neglect of an officer, director, or manager or partner, then that officer, director, manager, or partner, as the case may be, shall be guilty of an offense. The Commission believes that these rules are comprehensive and robust and will benefit the development of the sector. I note again that the consultation period ends March 15th, and we encourage you to provide comments. Once the rules are promulgated, you will be bound to comply, and any changes required will mean that the Commission must go through the full process of amending the rules. And in this regard, it really has way more impact if we get your comments before we promulgate, so that the industry's concerns can be reflected in the final version of the rules. With that, I thank you for your kind attention, and I'll now pass it back to our moderator. Sam?
Thank you to all of our presenters for those enlightening updates. That concludes the presentation segment of the briefing, and we will now open up for questions. I see we have already had some questions come through in the chat and the Q&A function, and Ms. Roll has been answering them as we've been going on. So if you have any more questions, please put them in the Q&A function or the chat function, and we will try to get through all of them. And our first question that we'll ask for the panel would be, does the SCB plan on looking into the following with regards to directors on investment funds? 1, implementing a Directors Registration and Licensing Act or rules to ensure that directors on investment funds are competent and able to fulfill their responsibilities. 2, requiring that at least one director of an investment fund be locally domiciled. There are many benefits for the jurisdiction by having this requirement. One benefit is shown by the effects of COVID-19 on business operations and professionals/directors. COVID-19 has shown how important it is in protecting the jurisdiction's reputation that directors be more greatly subject to local regulations and within the easy reach of the local regulator. During COVID-19, the ability to reach some directors was made difficult due to changes in working locations and offices being shut down. And the third part got cut off, but I'll read what I can see. We are still seeing corporate directors on investment funds, even though it would appear that the rules and asking for biographical, and that's when it cuts off. Ms. Rowland would like to take that question?
Yes, I believe that question is from Ed Ramming. And so Ed, you have a lot of questions in there. And so I'll try to address all of the questions you pose. So the question really crosses over two pieces of legislation. It hits mainly within the Investment Funds Act, and then it potentially crosses into the FCSP. So the short answer to your question is yes. The Commission is contemplating it. So when we were developing the Investment Funds Act, and prior to the development, prior to 2019, we considered this issue of creating a sort of registration regime for directors. We thought at the time, though, that we didn't have enough time to fully contemplate all of the issues, especially within the context of the FCSP not being where we needed it to be at the time. I think, though, that now we have fleshed out the activities under the FCSP and also we've addressed the issue of directors. And in the context of corporate services, excuse me, we can revisit this issue as it relates to a regime for investment funds. Now, the specific question you asked about requiring at least one Bahamian domiciled director of a fund, I think that issue we will definitely have to consult on. I mean, we didn't have the intention of doing that, particularly if you look at the principles behind an IBC, where the directors can be anywhere in the world. We would need to ask ourselves, in an open fund regime where the administration can be anywhere in the world, where the audit can be anywhere in the world, why would we then want to have a director that's localized. And maybe you're saying, maybe your answer to that is exactly because the other things can be anywhere in the world, but I'm not sure that that is the right answer to achieve the openness that we want with the investment fund regime. So I think that's something we would have to look at. So I think I've answered your questions. I think the rest of that was commentary, so I think I've answered it.
Okay, thank you, Ms. Rowell. Our next question, isn't it time to consider either a super regulator or transfer responsibility for the supervision of trust business to the Securities Commission? At present, we have to advise our trust clients that the central bank is the regulator for their trusts, but the Securities Commission is the regulator for the corporate entities underlying their trusts. Most comparable jurisdictions supervise fiduciary business, which encompasses both trust and corporate business. Apart from the regulatory risks associated with the division of responsibilities, we seem to be complicating, not easing doing business from both the client and institution perspectives. Ms. Rowell, I guess that's another one for you.
Okay, so I don't know. I mean, I don't know that I'm competent to answer the question of whether it's time for a super regulator. What I can, though, answer is some issues that relate with respect to a super regulator and what we see in other jurisdictions when we see a super regulator. So for the most part, the Securities Commission is a conduct authority. The central bank, for the most part, is a prudential authority. From everything we try to accomplish in the Bahamas, we don't have any activity that is regulated by multiple regulators. So for example, I think corporate service was the last thing that was regulated by both the central bank and the Securities Commission, and that now is only regulated by one entity, which is the Securities Commission. So if I can be entirely candid, this question of the super regulator, I don't know that the question is even posed with all of the issues and the ramifications of it well thought out. I think we pose this question in the context of what may be convenient for us, but we don't pose it in the context of what may be best for the jurisdiction in terms of its regulatory framework and how it needs to present itself on an international scale as a serious international jurisdiction. The Commission has looked at this issue of how super regulators operate. And some of the things that we found is that jurisdictions that have one regulator, where, so for example, Cayman has a monetary authority, Bermuda has a monetary authority, Singapore has a monetary authority. For the most part, those jurisdictions do not appear to have control of their own monetary policies. Okay, and so the issue of conduct versus prudential regulation are issues that are not as relevant for those jurisdictions as they may be for jurisdictions with their own monetary policy. What we also see is that the one example, and the UK is the one example where a jurisdiction attempted to create a super regulator that is combining the monetary and the prudential as well as the conduct authority. That was in the UK. I can't remember the years, but it was the early 2000s. But that was essentially considered to be a failed experiment. And shortly after it was put in place, the authority was then split out again in a prudential authority and a conduct authority. Now, so I think as opposed to saying one super regulator, what I would reframe that question as is whether it's time in the Bahamas for us to have only two regulators, one which is a prudential authority and the other one which is a conduct authority. Now that may be the more appropriate context for us, and I think that yes, it's perhaps time in the Bahamas that we look at those issues. If I were aligning the issues, I would say that something like insurance, as well as banking activity, and when I say insurance and banking activity, I'm aligning those issues that can have systemic impact in the economy. If they were to fail, then they should all be under a prudential authority, one prudential authority, and then all other issues under a conduct authority. And yes, I think that the time has perhaps come for that, and we can perhaps begin to look at that.
Okay, thank you. Another question has been posed. As a registrant under the SIA and as a FCSPA for corporate services only, is there an expectation to have separate AML CFT policies for each license?
Good morning. I think that as the AML CFT rules are currently rolled out, we do speak to them according to sectors, so that with the SIA, you have the SIA licensees and IFA activities falling under the SIA rules. And then we have the FCSPA AML CFT rules, and the Commission is currently in the process of developing AML CFT standards for DARE. So if I understand the question correctly, I think the answer is yes, you will have separate rules around anti-money laundering for each of the sectors that the Commission oversees.
Okay, thank you, Ms. Marmor. I think this may be for you as well, or Ms. Rule. Can you please elaborate further on why licensee by Central Bank of the Bahamas will not be considered a money lender, particularly if one of the products/services falls under this category?
So licensees under the central bank who are in the business of lending their licenses banks, and so there's no need to duplicate that regulation here. So that's the short answer. They're already regulated as a bank.
Okay, thank you. Next question. Is the FCSPA intended to capture non-custodial wallet services? I note that the definition refers to storage of keys, which would indicate only custodial wallets are captured. But since there's a separate business activity covering custody, just want to be clear.
Yes, so I think that question is from Aaliyah, and the short answer is yes, the FCSP does capture non-custodial wallet services. That is the category of digital wallet providers. And it's specifically put there for non-custodial wallet services.
Okay, next question. Are nominee entities required to register under the FCSP even though its parent under which it acts as nominee is registered under the FCSP?
So if a parent is registered under an FCSP, a nominee of that parent, as long as it's only providing services on behalf of the parent. Now, if it's doing other standalone services that are not on behalf of the parent, then it would have to be licensed separately. But if it's only doing services on behalf of its parent, then no, it doesn't have to have a separate license.
Okay, another question. They start by saying, thank you for the session. The proposed rules are very similar in nature and content as those proposed in 2016. At the time, several impacted entities provided comments which do not appear to have been accepted. Will there be an opportunity to understand the rationale for non-acceptance by the Securities Commission to allow those impacted to be better informed on further feedback?
Yes, so Roselle is right. These rules were initially issued in 2016. What the Commission intends is at the end of the consultation period, we will publish all of the comments and questions we received and how they were addressed. And so that would give the rationale for any comments or queries that we did not address. Because, like you said, some of those were not necessarily accepted some may have been addressed in other ways, or sometimes we think that it may be more appropriate to address something in a policy rather than in a rule. And so I think we will publish why the commission included, took into account some comments and why we did not.
Okay. Also, as a registrant under the SIA, dealing as an agent and arranging deals and FCSPA corporate services only, are we required to perform risk assessment for each?
Hi, thank you for the question. The answer is yes, because your risk assessments are performed based on the services you provide and your products. So even if it's an overall assessment, you have to ensure that you cover each of the services you do. So I don't know if you have it at a group level, but then you need to break out, what you do in your broker-dealer license as opposed to what you do as corporate services.
Okay, thank you, Leslie. Another question by Roselle Moxley. Please share the Securities Commission's thoughts on how private lending and commercial bank lending reconcile. Are they seen to the extent of lending activity to be the same or different? This is relevant to help provide context for any instance in which the rules may treat our private lending activity differently to the way the same is treated by the central bank.
Okay, so Roselle, I'm not sure that that these rules are meant to reconcile what we call non-bank, and I think you're calling that private, non-bank lending with commercial bank lending. These rules are simply meant to address the non-bank lending space. That means that someone is not lending money from their clients' deposits. They're lending money from their own assets. And so these are only conduct issues that we are addressing in this fair. I think that the appropriate entity to address conduct activity for commercial bank lending would be the central bank, as they cover commercial lending by commercial banks. As far as I'm aware, though, the central bank has not issued any conduct rules for commercial bank lending. They have issued prudential rules, but not conduct rules. If you notice throughout these draft rules, these are entirely, I think, except for one or two provisions, conduct rules. And so yes, you will see disparities. So, for example, one obvious disparity would be I don't think that there's any real cap on the rate of interest a commercial bank could lend at, except in as much as the Rate of Interest Act puts a cap on the rate at which you can lend. However, in our sphere, and in the context of these rules, we specifically address the calculation of interest to ensure that it doesn't go over the rate of interest cap. And I don't think that kind of restriction exists in the commercial banking sphere. But don't quote me on that. You asked for the commission's views. I'm just giving you views. And the other thing, though, is on the other hand, the debt service ratio that is allowable under these rules, I think that it's tied to the minister's rate, which is, I think, maybe 75%. The commercial banks, they impose a debt service ratio that's much lower than that. Now, I do not think that they have any any kind of restriction in the debt service ratio they can impose, and I think they do that by practice and agreement amongst themselves as a group. But again, I think the correct sphere of that is the central bank. But I guess the point I want to make is that, which is the point that I made at the very opening of this question, which is that these rules are intended to address conduct with respect to non-bank money lending.
Okay, thank you. I saw about 2 more questions that were in the chat, just so we capture all and get through them quickly. One question was, please advise if you're registered with the SCB under the SIA and FCSP providing corporate activities, are you required to provide a registered agent for both? Please advise if you're registered with the SCB under the SIA and FCSP providing corporate activities, are you required to provide a registered agent for both?
I'm not sure that I understand the question, but if what you're saying is that you have a dual registration and you're with the same corporate entity, I mean, the corporate entity only needs one registered agent. So, but I mean, I think that's my understanding of the question. But if the question was different, please clarify it.
Okay, thank you. What is the Commission's view on financing projects in order to receive a commodity and help the third party to build infrastructure, for example, oil metals, and receive repayment over term? It says TM, but I don't think it's term.
Okay, so I think this person was trying to clarify a question or to be more specific about a question that was answered in the Q&A. And I think that the answer still is the same. It depends on whether they're in the business of it or whether it's a one-off transaction between related parties and related party entities. If they're in the business, then it's clearly money lending. However, if it's a one-off or an occasional transaction between related party entities, then we wouldn't consider this to be in the business and it would not be covered.
Okay. Another question just came in the chat. Could you please confirm whether a group financing company would be deemed a money lender? The discussion suggests that since this would not be public lending, this would not be captured. Does the position change whether the group is comprised of resident companies versus non-resident companies?
So the short answer is no, they would not be included as in the business of money lending, and it does not matter whether it's resident or non-resident. It would be excluded from the business of money lending.
Okay, I think we have covered everything. Yep, I think we've covered everything in the chat. If you have any further questions, you can, of course, send them in to the Commission, and we will hope to address them at the soonest possible time. So I'd like to again thank the panelists for their enlightening and stimulating presentations and for answering the questions. That was a very stimulating session, and your engagement is greatly appreciated. Open and frank dialogue between the industry and regulator are essential for achieving and maintaining an effective, holistic regulatory regime. To note, today's presentation will be made available along with the recording on the Commission's website at www.scb.gov.bs. The Commission encourages you to like, follow, and subscribe to the social media pages for the latest updates from the Commission and industry news. The Commission also encourages you to reach out in case you have any additional questions or comments. Next month, the Commission will be hosting another update on the Digital Assets and Registered Exchanges Act, DARE, regime, so please stay tuned for further details on that industry briefing. On behalf of the Commission, I would like to thank each one of you for, again, taking the time to join us this morning, for all your very informative and enlightening questions, and we hope you have an enjoyable afternoon. We hope to see you again next month. Thank you.